Gold just had its worst week since March 2020, down 3.6%, from 4660 down to 4493 in 5 sessions. But here's what really got me. Every major bank on Wall Street is still saying 6,000 by year-end. So who's right, the price or the banks?
And while gold was bleeding, Morgan Stanley, the same Morgan Stanley whose former CEO said he never understood Bitcoin, just filed to launch the cheapest spot Bitcoin ETF on the market at 0.14%. Meanwhile, Anthropic accidentally leaked what might be the most powerful AI model ever built. What connects all of this? One word: Iran.
Stay right there. We're going to unpack all of it.
Hey everybody, welcome to Money Moves. I'm Maya Tech.
And I'm Rich the Stacker. This is Money Moves, where physical assets meet the digital future. Every week we break down gold, silver, crypto, and AI, and what it all means for your money. This is episode 1. And folks, we picked one hell of a week to launch.
Here's what's coming. Gold and silver, why the worst weekly drop in 6 years might actually be a buying opportunity. Then crypto, the bloodbath, the options expiry carnage, and Morgan Stanley's surprise ETF filing. AI news that literally moved the stock market, and we'll tie it all together at the end with our first prediction. Let's get into it.
All right, let's start with gold. Spot price as of Friday, $4,493 an ounce, down 3.6% on the week. We opened Monday around 4660, hit a gut punch low of about 4100 on Tuesday, and clawed back to close Friday just under 4500.
Let's put that in context because context matters. Gold hit 5,200 in early March. It's now at 44.93. That's roughly a 15% pullback in 3 weeks. And in January, gold was trading above 5,600. That was the all-time high. So from peak to today, we're looking at a 20% correction.
Here's the thing people forget. This kind of pullback has happened before. In 2011, gold ran from 1,500 to 1,900 and then dropped 20% in 3 months. Everybody panicked. People were saying the gold bull market was over. And you know what happened? It consolidated and eventually went higher. Pullbacks in a bull market are healthy. They're supposed to hurt.
Okay, so here's what's interesting. 3 forces are crushing gold right now, and they're all connected. Number 1, the Fed is signaling 0 rate cuts for 2026. The CME FedWatch tool has 0 cuts priced in, and there's actually a 35% chance of a rate hike by year-end. Number 2, the US dollar is at 8-month highs. And number 3, Treasury yields are surging because oil is above $100, which is fueling inflation expectations.
And that's the cruel irony here. Iran threatens the Strait of Hormuz. Oil spikes above 100, and you'd think, war, chaos, buy gold, right? That's the textbook playbook. But no, the oil spike fuels inflation fears, which pushes the Fed further from cutting rates, which strengthens the dollar and raises real yields. And gold, which pays you nothing to hold, gets sold in favor of treasuries that now yield more.
Respectfully, I disagree with how you're framing that. The safe haven bid for gold didn't fail. It got overwhelmed by the rate mechanism. Gold actually rallied hard on Tuesday when the Iran news first broke. It's the second order effect. Higher oil means higher inflation means tighter Fed. That reversed it. The safe haven impulse is still there. It just lost the tug of war this week.
That's a fair point, Maya. And look, here's what gave me some relief on Friday. Trump announced a 10-day pause on military strikes against Iran's energy infrastructure. Gold immediately bounced almost $80 from around 4,400 back up toward 4,490. That tells you the safe haven bid is coiled up and ready. It's just waiting for the geopolitical pressure to ease.
And that bounce was telling because it happened on a Friday when traders normally want to reduce risk before the weekend. Instead, they bought gold into the close. That's conviction buying.
Now let me paint a picture for anyone watching who doesn't live in this world every day. When gold drops 15% in 3 weeks, every headline screams crash. But zoom out. A year ago, gold was around 3,100. Today, even after this pullback, it's at 44.93. That's a 45% gain in 12 months. That's not a crash. That's a healthy correction inside a monster bull run.
Let's talk about what the big banks are saying because this is really telling. Wells Fargo just raised their year-end gold target to $6,100 to $6,300. JP Morgan is at $6,300. Deutsche Bank is at $6,000. From current levels at 44.93, that implies 38 to 43% upside by December. All 3 are calling this pullback a buying opportunity.
Let me tell you something. When Wells Fargo, JP Morgan, and Deutsche Bank all agree on something, either they're all right or the world has fundamentally changed. I'm inclined to trust the consensus here. The structural story hasn't broken. Central bank buying is still there. The dollar diversification trend is still there.
Speaking of central banks, China's People's Bank extended its gold buying streak to 15 consecutive months as of January. Holdings at 74.19 million ounces. JP Morgan expects about 755 tons of central bank purchases in 2026. That's below the 1,000 plus tons we saw the last 3 years, but still well above the pre-2022 average of 4 to 500 tons a year.
And here's what I think people are missing. Central banks don't panic sell. They buy on dips. China didn't stop buying gold when it went from 2,000 to 3,000. They kept buying. You think they're going to stop now that it pulled back from 5,600 to 4,500? This is a gift for them.
The reason central banks are buying is the same reason they've been buying since 2022. De-dollarization. They want to reduce their exposure to dollar-denominated assets. And that trend doesn't reverse because of one hawkish Fed meeting. It's a decade-long structural shift.
Exactly. And if you're watching this and you own physical gold, I want you to hear this clearly. The reason you own physical gold hasn't changed this week. You own it because you don't trust governments to manage their currencies responsibly. Nothing about this week's price action changes that thesis. Not one thing.
Now let's look at silver. Spot price, 67.97 per ounce as of Friday, down 4.5% on the week. It opened above 71, cratered to about 61.20 on Tuesday, which was a brutal intraday low, and recovered to close just under 68. The gold-silver ratio widened to about 65 to 1 on Thursday, before tightening slightly to 63 on Friday.
Silver, the poor man's gold. And before Maya rolls her eyes at me, I know she hates when I say that. But look, silver got hit harder than gold this week, down 4.5% versus 3.6 for gold. That ratio widening from 63 to 65 tells you people are hiding in gold, not silver, during this panic.
I do hate when you say that, but here's why silver is the more interesting trade right now. About 60% of annual silver demand comes from industrial applications: solar panels, electric vehicles, electronics. And here's the AI connection we'll dig into later. The massive power build-out for AI data centers, over $500 billion in hyperscaler investment expected globally this year, requires energy infrastructure. Solar is a big part of that, and solar panels need silver paste.
I've been wrong before, but I think the industrial demand story for silver is a bit overhyped. Yes, solar panels use silver paste, but when recession fears pick up, and they are picking up with oil above 100, industrial demand drops. Silver's dual personality as both a precious metal and an industrial metal makes it more volatile, and that volatility cuts both ways.
Let's look at what the data actually says. JP Morgan sees silver averaging $81 per ounce in 2026. That's about 20% above current levels. Silver surged over 130% in 2025. Yes, it's pulled back, but the supply deficit is structural. You can't just turn on new silver mines overnight. It takes 7 to 10 years from discovery to production.
You know what, Maya? You might be right on that. The supply story for silver is genuinely different from gold. New mine supply hasn't kept up with demand for years. I still prefer holding physical gold in my hand over a silver industrial thesis, but I respect the data.
And let me add one more data point for the silver bulls out there. In January, silver was trading above $100 an ounce. Today, it's at 68. That's a 32% pullback. If you believe the industrial demand thesis and the data supports it, then $68 silver could look very cheap a year from now.
And if you're watching and wondering what to do right now, I want to be clear. This is not financial advice, but every major Wall Street bank is calling this a buying opportunity for precious metals. The question is whether you can stomach the volatility while the Iran situation and the Fed play out. That's the trade-off.
Okay, that's the metals picture. Down hard, but structurally intact, with massive institutional backing. Let's move to crypto, where things got even uglier.
All right, crypto. Bitcoin closed the week at $66,457, down 6.4% in 5 days. And I want to remind everyone, Bitcoin peaked above 126,000 back in October 2025. It's now 47% below that all-time high. Fear and greed index, 13 out of 100. That's extreme fear.
3 things drove Bitcoin's decline this week, and they hit simultaneously. 1, the Iran conflict pushed oil above $100 a barrel, triggering a risk-off stampede across all markets. Stocks, crypto, everything. 2, the $14.16 billion quarterly options expiry on March 27th, the largest of 2026, triggered over $450 million in forced liquidations and wiped out 122,000 individual traders.
122,000 people wiped out in one session. Let that sink in. That's not a healthy market structure. That's a casino where the house just called everyone's margin.
And number 3, the Nasdaq entered correction territory this week. And Bitcoin's correlation with the S&P 500 hit 89%. Bitcoin also showed 95% correlation with gold during the March 19th sell-off, meaning everything sold together. There was no safe haven anywhere.
That's what I keep coming back to. Does Bitcoin actually behave like digital gold, or is it still just a risk asset? Because when Iran rattled the saber, gold sold off a little and then bounced. Bitcoin just kept falling, 89% correlated with the S&P. That's not a store of value, that's a tech stock with extra steps.
Respectfully, I disagree. Yes, the short-term correlation with equities is high, but here's the counter data. The Bitcoin gold correlation actually flipped positive this week for the first time in weeks. That means the market is beginning to treat Bitcoin less like a tech proxy and more like an alternative store of value. It's an incomplete transition, Rich, not a failure.
I hear you. But transitions don't pay your bills when you're down 47% from the high and a 24.6% year-to-date decline. If you're holding Bitcoin right now, the digital gold narrative isn't exactly putting food on the table.
Fair. But here's the institutional story underneath the pain, and it's remarkable. Morgan Stanley, yes, the Morgan Stanley, just filed for a spot Bitcoin ETF, ticker MSBT, at an industry low fee of 0.14%, which undercuts BlackRock. This is the first major U.S. bank to launch its own Bitcoin ETF. They have 16,000 financial advisors managing $6.2 trillion in client assets.
Let me tell you something. When the biggest wealth management firm in the world files for a Bitcoin ETF at a fee that low, they're not doing it for fun. 0.14%. That's a fee designed to move trillions of dollars of retirement money into crypto. Morgan Stanley sees where this is going, even if the short-term price action is ugly.
And there's more bullish infrastructure building underneath the surface. Stablecoin supply is near a record $316 billion. That's capital parked on the sidelines, waiting to re-enter the market. Bernstein is maintaining a $150,000 Bitcoin target for 2026. The pipes for a massive rally are being laid right now, even as prices fall.
Now let's talk altcoins because they got massacred this week. Maya, start with Ethereum.
Ethereum broke below $2,000 for the first time since mid-2025. Trading at 1985, down 7.5% on the week. It's now 60% below its August 2025 high of 49.53. And the alarming stat, March 26th, was the first day in 2026 where Bitcoin, Ethereum, and Solana spot ETFs all posted simultaneous net outflows. Institutions hit the sell button on everything at once.
Solana took it even worse. $83.14, down 8% on the week. That's 72% off its cycle high. And unlike the others, Solana's on-chain activity is deteriorating alongside the price. Network transactions down 3.2%, active addresses down 11% over the past month. When both price and usage fall together, that's a real warning sign.
And then XRP, which has the most frustrating fundamental story right now. The SEC recently classified it as a digital commodity. That's an incredibly bullish regulatory development, but it's trading at $1.34, down 6%, 65% below its July 2025 cycle high of $3.65. The macro headwinds are completely steamrolling what should be great news.
That's what happens in a risk-off environment. Fundamentals don't matter when people are running for the exits. You can have the best supply story in the world and still get crushed when the tide goes out. When fear takes over, everything is for sale.
So here's the big question. Is the crypto sell-off helping or hurting precious metals this week? In my view, it's actually neutral to slightly bullish for metals. The simultaneous sell-off is compressing correlations. When things bottom and the recovery starts, capital that flowed out of both will flow back in. And gold's structural bid from central banks gives it a head start on the bounce.
I'll take the other side. The crypto sell-off hurts gold in the short run. Because when Bitcoin holders get margin called and liquidated, $450 million this week alone, some of that pain was probably funded by selling gold positions or gold ETF shares. In a liquidity crunch, everything is correlated. Everything sells together. That's just how it works.
That's fair in the short term. But the $316 billion in stablecoin reserves is a powder keg that benefits both markets. When the Fed eventually signals even a shift in language, not action, just language, that capital will move fast. All right, let's shift to AI news. Things got really wild this week.
So Anthropic, the AI company behind Claude, accidentally leaked details about their most powerful model yet. It's called Claude Mythos, codenamed Capybara. A CMS misconfiguration, basically somebody left a database unsecured, exposed nearly 3,000 internal documents.
And here's what was in those documents. The leaked draft blog post described Mythos as, and I'm paraphrasing carefully, currently far ahead of any other AI model in cyber capabilities. They also warned it poses unprecedented cybersecurity risks. This is the AI company itself saying this about their own product. The new Capybara tier sits above their existing top models.
Let me tell you what worries me about this. When an AI company says their own model poses unprecedented cybersecurity risks, that's not marketing hype. That's a warning label. More uncertainty, more disruption potential, more chaos in markets. And in my world, chaos has always been good for gold.
Okay, so here's what's interesting from an investor lens. On the day that news broke, the iShares Expanded Tech Software Sector ETF, ticker IGV, dropped nearly 3%. And because of the high correlation between tech stocks and crypto right now, that sell-off in tech pulled Bitcoin down with it. An AI Labs accidental data leak literally moved the crypto market. That's how interconnected everything is now.
Here's the thing. Both Anthropic and OpenAI are racing toward IPOs later this year. OpenAI has their own frontier model codenamed SPUD in development. So you have two companies pushing the absolute boundaries of AI capability right before they ask the public to value them at hundreds of billions of dollars. The pressure to build the most impressive model possible is immense.
I see the cybersecurity angle as double-edged. Yes, Mythos could be used to attack software systems, but it could also defend them at unprecedented levels. That creates investment opportunities in cyber defense firms. But for our audience, the money audience, here's what matters. The AI arms race is accelerating, and it's driving massive investment in compute and energy infrastructure, including silver for solar panels powering those data centers.
There's a regulatory angle too. The Trump administration is pushing Congress for a single national AI framework. Right now, multiple states have passed their own AI safety laws. The White House wants to prevent a patchwork of 50 different regulatory regimes. Senator Blackburn's Trump America AI Act is the leading proposal.
For investors, the regulatory question is basically binary. A single federal framework benefits big tech. Simplified compliance, faster deployment, better margins. A state-by-state patchwork creates drag and higher costs. We don't have resolution yet, but it's moving fast. Keep your eye on that.
Either way, the uncertainty is real. AI is simultaneously the most exciting and most destabilizing force in the economy right now. And uncertainty, in my book, is always a good argument for owning gold. All right, let's tie it all together.
Okay, this is the part of the show where we connect the dots between crypto, AI, and precious metals. And this week, there is one story that sits right at the intersection of all three. Bitcoin miners pivoting massively to AI.
This is a wild story. A CoinShares report showed that publicly traded Bitcoin miners spent an average of almost $80,000 to produce each Bitcoin in Q4 of 2025. Bitcoin is trading around 66,000. That means they're losing roughly $19,000 on every single coin they mine. So what are they doing? They're pivoting their entire infrastructure to AI data centers.
The numbers are staggering. Over $70 billion in AI and high-performance computing contracts signed across the public mining sector. Core Scientific already gets 39% of revenue from AI. TeraWulf has $12.8 billion in HPC contracts. Hut 8 has $7 billion. Industry-wide, these companies could derive 70% of revenue from AI by end of 2026, up from 30% right now.
And here's what connects this directly to Bitcoin's price. Miners are selling over 15,000 Bitcoin from their treasury reserves and taking on billions in debt to fund the AI transition. Mining difficulty dropped like 7.76% on March 20th, the second largest decline of 2026. Hash rate fell from 1160 exahash per second to around 920. The AI boom is literally reshaping Bitcoin's security model.
So here's the debate, Rich. Is the miner pivot to AI bullish or bearish for Bitcoin?
I'll take bullish, and here's why. This is Darwinian evolution. The weak miners die, hash rate concentrates in the strongest operators, and difficulty adjusts downward, making it cheaper for the survivors to mine. Plus, the same energy infrastructure they're building for AI will eventually power Bitcoin mining again when the economics flip back. This is painful in the short term, but it's healthy for the network long term.
Respectfully, I disagree. The best capitalized Bitcoin companies in the world are choosing AI over Bitcoin. They're literally selling their Bitcoin to fund the transition. Hash rate is dropping. The digital gold narrative just failed its biggest real-world stress test. When the people closest to the network, the ones who actually run the infrastructure, are running toward AI that tells you where the smart money sees better risk-adjusted returns.
You know what? That's a strong argument. And the market agrees with you. Listed miners with AI contracts trade at 12.3 times. Forward sales versus 5.9 times for pure play miners. The market is literally paying double for AI exposure.
But here's where I'll give you credit, Rich. This pivot is bullish for silver. These AI data centers need massive amounts of power. Solar installations use silver paste. Over 500 billion in hyperscaler investment globally this year means more data centers, more power demand, more solar, more silver. The AI to silver pipeline is real.
So, net, where do we land this week for precious metals?
I'd say neutral to slightly bearish short term, but bullish medium term. The hawkish Fed, the strong dollar, and rising yields are real headwinds that aren't going away next week. But the Wall Street consensus, Wells Fargo, JP Morgan, Deutsche Bank, all say 38 to 43% upside by year end. The key variable is oil. If oil comes back toward $80 or $85 a barrel, inflation pressure eases, rate cut expectations revive, and gold rips higher.
I'm with you on that. Short-term pain, medium-term gain. The structural story, central bank buying, dollar diversification, geopolitical instability, none of that has changed. What's changed is the rate environment, and rates can shift faster than people think. One dovish sentence from the Fed and gold gaps up $200 overnight. All right, let's make our first prediction.
Okay, this is where we put our necks on the line. But first, the disclaimer. This is for entertainment only. This is not financial advice. We're just sharing our opinions on where things might go. All right, with that said, every week we're going to make one specific prediction, something we can grade, something probably right or wrong by year end. Rich, where's your head?
I want to call gold hitting 5,500 before September. That's about a 22% move from here. When this Iran situation resolves, and I believe it will, and the Fed starts even hinting at a pivot, gold is going to snap back hard. Central bank buying provides the floor. The snapback provides the thrust.
That's aggressive given where we are. Gold is in a downtrend. The Fed is frozen. September is only 5 months away. I'd go a bit more conservative on timeline. How about gold breaking 5,000 before October 1st? That gives us an extra month and aligns with JP Morgan's forecast of 5,000 by Q4.
October works, but I want the number higher. 5,000 is only an 11% move from here. That's nothing for gold in a bull market. Let's say 5,200. That's a 15.5% target, and it's still below the early March high. We're basically predicting it retakes the March high before October.
Let's look at what the data says. JP Morgan sees 5,000 by Q4. Wells Fargo sees 61 to 6,300 by year end. Splitting the difference and applying a timeline? Yeah, I can get behind 5,200 by October 1st. It's specific, it's falsifiable, and it requires gold to fully retrace this correction. I'm in.
Done. Our prediction for episode 1, gold breaks $5,200 per ounce before October 1st, 2026. Again, just for entertainment, not financial advice. We'll grade this every single week on the show. If we're wrong, we'll own it on camera.
And let me name the risk clearly. If oil stays above $100 and the Fed actually hikes rates, this prediction is dead. That's the bear scenario. We acknowledge it, we respect it, but we don't think it's the base case. Now we want to hear from you. Do you think gold hits 5,200 before October? Drop your take in the comments. Tell us if we're crazy or if you agree.
All right, folks, that's episode 1 of Money Moves. Our prediction, gold breaks 5,200 before October 1st. If you got value out of this, hit that subscribe button and share it with someone who cares about their money. I'm Rich the Stacker.
And I'm Maya Tech. Next week, we'll grade our prediction and we'll cover whatever chaos the market throws at us. Until then, stay sharp, stay curious, and make smart money moves. See you next week.